Welcome back to DeVito's podcast. Today we're going to be diving deep into Bitcoin, startups, and other types of business adventures. I have a special guest here with me, Mr. Daniel Gomez. He's been on the podcast before. Daniel, thank you so much for joining us again. It's an absolute pleasure. I think we're going to have a fun time giving the audience and plus myself, an opportunity to catch up on what you've been doing, how you've been investing in, your startup experience. So for those who have maybe no history of knowing who you are, can you give us a little background about yourself?
Yeah, of course. Thanks for having me, Joe. Currently a full-time MBA student at USC. Um, Prior to that, I actually know Joe from undergrad. So we went to university together. I don't know if you want me to name drop, but that's where I met Joe. And after I graduated, I'm a couple years older. I got into real estate, specifically asset management. And so I did asset management for residential housing for about 5 years before I decided to sort of leave that world, at least for now, put a pause, take a break, sort of reevaluate where I want to go. And I decided to join the MBA program. I got into SC, and that's really opened up my eyes into all of the business opportunities that are out there. And yeah, that's what I'm doing now. That's opened up the doors to learning about startups and venture capital, venture funding, and how those work. And that's where I interned this last summer. So that was sort of like my last piece of work experience. I entered for the startup in Santa Monica, and we can get more into it. But I'm excited to be back on the podcast here with Joe, and I think it's going to be an insightful conversation.
Wow, that's amazing. For those who don't know, startups are very hard to get going because, they're considered startups, whether it comes to funding or, interest from outside investors and just the overall idea of trying to, entice the market that you have a valuable product or service. And I don't have the exact stats on me, but something like 80% of startups do not make it within the first something like 2 to 3 years.
Yeah, it's like 90% actually. Yeah,
Wow.
90% of startups fail, right? Which is pretty scary, right? But again, it's sort of a numbers game. Like you can have 10 startups within a portfolio that fail, but if you get that one that just, either gets acquired or makes an IP, goes IPO, goes public, then you can essentially recapture all those losses and more, with one winner. So you shoot really, they call them unicorns. You shoot for the billion-dollar startup. Uh, and that's how I think that's what makes the risk worth it in the long term.
That's a great point. What type of like unique challenges have you faced or have startups faced that maybe were not prevalent a decade ago or within 5 to 10 years ago?
Yeah, well, I think a lot of the same challenges that were there 10 years ago are still here today. And it's really finding, right, like the investment that is going to be the unicorn. I think today, with, higher interest rates, things can be a little bit trickier. And I would say that a lot of those same challenges are prevalent today. Like, for example, if you're starting a company, from scratch, you need to get funding. And I think during today's time, uh, there's been sort of a slowdown in the economy over maybe the last couple of years. Investors are a little bit more hesitant to put money down on what you can consider a more speculative investment. They try to go with the safer investment. So it's harder to get funding. In addition to that, like today, there's so many things that you have to watch out for. Like, I believe the startups that do very well now are the ones that are adapted to the changes of technological changes like AI. AI is like such a huge word that gets thrown around, but like if that's not part of your startup, you're sort of behind, right? Another one is sustainability, uh, and sort of like being environmentally conscious. So I feel like today's startups that do become successful in some ways have to have uh, a few of the following things. They have to be a sustainable company, aside from all other things considered, right? Like profit, like I'm talking as far as they all have to be profitable, but in addition to that, they have to be sustainable and they have to utilize technologies that are emerging. And so I guess that can be said for the startups 10 years ago as well. I think the new component is sort of the sustainability aspect. And investors want to be making an investment to gain a profit, but they also want to make sure that it's an investment that is sustainable and that's you know not maybe not um, promoting high carbon emissions and all this other stuff that you have to be aware about. So
That's actually a really good point because I've read about a lot of startups, a lot of companies get graded, and how environmentally friendly they can be. What was like ESG reports,
Yeah.
and it's honestly insane how much carbon companies emit. Now I know I don't have like the facts if it's, a detrimental impact to our environment about the carbon being released into the atmosphere from the process of how these business operate. But even like technological companies and whatnot, people think like, oh, they're technological. How can they emit carbon? Well, a lot of these like, functioning components could be, within these technological companies, whether it's like computer driven or whatnot, and machine driven. And people don't realize like how much energy it takes to drive these companies. And there has to be something expelled, right? For something that's inputted, something has to be expelled. And people, I guess, don't realize like some of the largest companies in the world, emit the most carbon dioxide more than sometimes like companies that like, even automobiles combined. And
Right.
I don't think people even realize that. People think because they're not looking at it from a super tangible standpoint, like the exhaust on your car compared to maybe an AI data center, right? That's processing, so much electricity and so much output, maybe like what would be like carbon.
Right.
And they don't see that. But it's true though, going off your point of, the emissions and whatnot, and how they're graded on how sustainable they are. And another thing too that I was talking to a gentleman online and he told me that he was investing in a specific startup about 3 years ago.
Okay.
And this was when IPOs were getting crushed in the market, right? IPOs were getting crushed, like not in a good way.
Right.
And he goes, I invested 300,000 into this private company. It was a startup. I don't believe they went public. I think they exited, but it took 3 years and he only got back about $4,000 in profit. They barely broke even. And he says, if I were to invest that money into even an S&P, what do you call like a S&P 500 index fund or even like the tech market,
Right.
I would have made like easily, 60% plus on my money. But he says, but that's the thing that 300,000, it could easily go to zero if the startup fails, or it could become a million, it could become 5 or 10 million. You don't know. That's the risk you take. And he says, luckily, I didn't really make any money. He made about $3, $4,000.
Wow.
Like that does a funny story.
Yeah, it's funny. I took a class for like in venture capital this past semester, and uh, it's not the same as my experience with the startup I worked for because the startup I worked for was bootstrapped, meaning like you just had this individual, but with a co-founder, essentially uh, funded the startup with their own money, and that's kind of rare sometimes, especially like if it's a larger scale startup, which is the case. But like I did learn a little bit about venture capital and raising capital, and what we learned is that you want a new startup, you're looking at business opportunities that could 20x your investment. So ideally, that's what you want to shoot for. On the low end, 20 to 50x is what you're really targeting. So if you think a business, is going to do well, but you can maybe 5x your money, it still doesn't meet sort of the criteria. Even 10x doesn't meet the criteria. You want to find those unicorns, and it's really tough um, to bet on some of these because especially if they're like new startups, they call them like pre-seed, so they're sort of just getting started. They don't even have a product out yet. They have maybe a beta product or they're working on it. They have the idea and they're starting to work on it. It's really hard to bet on these, and because there's so many of them, like we mentioned, 90% of them fail. So you have to do your due diligence, really, and then a lot of it too comes down to like getting to know the team, the founding team, the founder himself, if he has a team, whether small or large, getting to know those people and their backgrounds and really betting on them to really take this thing off. But yeah, like it's a really risky, as an investor, it could be very risky to get into the startup world. But again, if you do become sort of that, you hit that 10%, or one of the startups in the 10% could be very lucrative and life changing.
Yeah, very much. I mean, 20 to 50x, that's an insane return. Like, how often would you see that in the stock market? Like,
Oh,
very
you're,
rarely.
you're the pro on this. Like, you're the stock market guy.
No, no, no.
Tell
I
us, bro.
I dabble. I dabble in the stock market.
You dabble, man. I'm
Like
calling. But
even I mean, I've seen returns, like close to like the 1,000% range, but that's like near 10xing your money. I mean, to look at a return of that scale, right? It's not like, oh, I put in $100 in the stock market, I made 1,000%, 10x your money. Like if you had a startup and it was that 10% that actually succeeded, and then you 20 to 50 extra money, like what's the original valuation of that company? Like if it was $1 million valuation per se, and you 20 to 50 exit, like, you could be in the $50 million range. But a lot of these, unicorns, right? They could be well into the hundreds of millions into the billions, as you would know. And
Right.
it's kind of like, wow, sometimes you just don't know how things like might turn out.
Right. Yeah, no, it's a again, it's a sort of a I don't want to call it a gamble because it's an educated guess, sort of like the, picking stocks and seeing what's going to go up. But there's like anything, there's certain criteria and certain things that you want to look for when valuing a company, especially at its early stages. And you know, it's in the long run, I think you just as an investor, you don't get into that until you're ready to lose, whatever money you're putting down. And most of these, the early rounds might be they might be raising it could be like more like the stuff you see on Shark Tank, like when you two, $300,000, right? Um, those are typically like the pre-seed or sometimes like the seed series. But once you get into the higher series, they've raised capitals in the millions, and that's when there's less risk, I would say, Series A, Series B, and so forth. But also your returns, because the company's valued much higher. As an investor, your returns are a little bit, what's the term they use? Um, I guess compressed, right? You're part of a bigger pool now, so your returns are going to be smaller and there's less risk again. So you're
That
probably
makes a
looking
lot
at
of
the five,
sense.
yeah, you're looking at the 5 to 10x at that point, maybe 20x, but yeah,
That's a good point though. The larger a company gets, the harder it is to create like a larger return. And I was telling this to my buddy today. Funny story. Like, Nvidia, they were, well, until today, right? They were near like over $3.5 trillion market cap. And I've been asking a lot of people, like analysts per se, and people who've been in the stock market for a really long time. I said, just looking at Nvidia, right, as a whole, if it's like $3.5 trillion, people were saying, oh, at current stock price, let's just say, for example, it's $100, keep it simple, right? $100. For it to go to like $200, right? It would essentially like double its market cap. So wouldn't that be like 7 trillion? I'm like, so people go, oh, it could easily hit $200, but I don't think you're looking at the amount of like liquid, the amount of equity that has to go into a company like that to drive it to 200. Like to hit 7 trillion market cap, you got to find $3.5 trillion of liquid from like institutional investors, retail investors, private investors, whatever. Well, not private, but institutional investors and then retail investors to pour that money into the stock, and to give it that higher valuation. I'm like, that's a lot of money. If you looked at a stock that's like $10 a share and it's $500 million, right, market cap, to drive it up to $1 billion, that is very easy to do.
Like, exactly. Yeah. When you're in the trillion, so actually, I just got the term. It's dilution of shares. That's what they call it. When companies are starting to grow, they got more shares, more investors in. But in the case with Nvidia, yeah. And I mean, it took how many years for Nvidia to get to 3 trillion, right? And it wasn't until recently it just popped off. Now, would it take that long again to double? I don't think so, but I think it's still, like you mentioned, it's a significant amount of you have to have a significant amount of investor confidence in the company to really drive that and double because we're talking trillions. The same goes for Bitcoin, and we can talk about that later. But Bitcoin's market cap over 2 trillion. Um, just to double the market. Some people talk about, well, Bitcoin is going to overtake gold, which I think can happen in the long term. But like during this bull cycle, you have to sort of be realistic sometimes. And while I think Bitcoin could potentially double its market cap, it would have to with like 7x its market, maybe 8x its market cap to overtake gold. And I don't think that can happen in a matter of months. I think that can happen in a matter of maybe a decade or so, or more than that. But yeah, you're like right on point with paying attention to the market cap number, which I think sometimes people ignore. And I think it's kind of human nature, right? You want things to go well for you. You got, you're sort of a smaller fish in the pond, and you want to double, triple, 5x, maybe even 10x your money. Um, but it takes a lot, for that to happen. I mean, it's a little rare, more rare than people think.
Yeah, I mean, if you were like investing back in the 80s or 90s when a lot of these, new tech companies like we spoke about, like these, these IPOs or these startups and whatnot, you look at like Apple, Amazon, Facebook, Google, Nvidia, they were all like within like the dollar range when it came down to share price, and people go, oh, I wish I was alive back then because I could buy all the shares in the world. But then you look at like a bunch of different factors, like the purchasing power of the dollar back then, like a dollar back in the 80s was worth more than what it is now.
Oh,
right?
I actually
You
want to, you know what? I'm gonna look that up. Like, I'm very curious about that. $1, the 1980s. I mean, I want to see what the value of that would be today.
probably like $3.
And you're
Or
like, you're right around the money. I mean, we're talking in 1980, right?
1980.
Yeah, $1 is 383 today.
Wow.
Isn't that
383.
yeah, no, $3.83.
Oh,
A
$3.
dollar, yeah. So it's increased like $2.83
Wow.
in 45 years, right? Yeah, we're in 2025, which is it's crazy, but
Yeah,
uh
so cash is not it.
yeah, it's appreciated what 77% from yeah, no, it's insane how the inflation stacks up over time.
Yeah, and then you look at these companies like, like the tech companies that were new and whatnot, being offered for, couple dollars a share. People go, "Oh, I want to buy a bunch of these, if I were alive back in the day." But like, back in the day, people like didn't know if a lot of these companies were going to be surviving, during the dot-com era. If a company literally had like dot-com after it,
Right.
people would buy into the company just because it had that. They wouldn't look at its valuation. They wouldn't look at its balance sheet, and it would oftentimes be way overvalued and it would fail between 2 to 3 years, and then people go like, oh wait, I just lost a bunch of money, but during the dot-com era that was like the big thing.
Yeah, that was sort of like I guess the one of the larger bubbles of our time, dot com and the 2008 bubble. Funny enough, we don't have to get too much into this, but one of the guys that built this last startup that I interned for, I mean, he's an older guy now, right? He's bootstrapping his own companies, but he started mentioned back in the dot com era when things are all these startups are taking a turn for the worse. So uh sort of seen it all, right? Coming out of that could be really scary to continue on your trajectory and sort of like the venture capital and startup space. Um, but it just goes to show, man, that markets kind of have their cycles, right? This guy, I guess, was um, he's persistent enough to keep going and build his own companies after seeing really like all the companies that he worked for, all the startups that their accelerator were investing into just pretty much crumble. I mean, so. Um, I think it's good to know, it's good to expect the best, but know that the market works in cycles, right? Joe, do you think, I mean, I feel like you're definitely more experienced, I guess, in the stock market and you follow it a lot more closely than I do and probably than a lot of people do. Uh, do you think we'll see a bubble coming up like in the next few, I would say, and what I mean by bubble, like, do you think we'll see sort of like a big, huge dip to the extent of that we saw maybe during COVID in that time in the next 2 to 3 years?
That's a really good question. I want to stay, I don't want to be optimistic or pessimistic. I want to be like a realist.
Right.
I personally believe we are on a bull cycle. Like you remember like the Roaring Twenties when
Yeah.
like every year was just a stellar return for the market. Um, During COVID, we had a great year in 2020 because we had a lot of money pumped into the economy when COVID began. Um, 2020, 2023 was when like the tech market sold off something like over 30%. The Dow sold off, I think, 20 plus percent, the S&P like 20 plus percent. It was a bad year. That was a pretty heavy sell-off. I don't believe that was like what we consider like a market crash where it was like 40, 50% down. That's a crash, right?
Right.
But what's nice is now is that we have I don't want to say like technology, but we have fail safes in place to where if the market were to try to trigger a crash like that, like a flash crash as they call it in stock terms, their computers, like would actually be able to trigger a fail safe to prevent that from actually going past that certain margin. So like so like for example, there's fail safes in place to where if the market wanted to sell off like 40 and 50%, for example, like which is, can you hear me?
Yeah, I can hear you.
Okay.
Yep.
If the market wanted to sell off like 40, 50%, I was reading about this where they have fail safes like integrated into like their computer systems and data and their processing where it would actually prevent that from going past like 15 to 20%. It's like a fail safe to prevent it from like basically falling out. Like it just halts in a way. We didn't have that, if I'm not mistaken, back in 2000, 2008. I believe it was instituted after that, like, fool me once, but fool me twice type of thing. And I don't think a lot of people even realize that's an actual thing. I guess it's to prevent even more of like a knee jerk of like a further market sell off, but it's a fail safe from what I was reading.
Yeah.
And
I have a question before like you keep. I don't mean to cut you off, but like, is this sort of like I'm trying to understand it? Uh, you've traded on like some of the apps like Robinhood and all that stuff. You know, when trading gets halted for a specific stock, that would happen, but for the whole market, if there's
Um,
with too much volume on it.
too much volatility.
Okay.
So, like for example, when Robinhood halts a stock, like they don't actually own the shares. They're like the middleman, right? Like let's just say you're trying to buy a share from me. I'm Robinhood. I'm like the third party or the middleman. I go to what's it called? I go to like a third party, like I don't know, like maybe like Citibank or whoever, and basically like I guess they have like those shares reserved, and then like they basically get transferred over in a sense, and then we make like a penny on like the trade or something like that. So that's like how these brokerages make money. But when so many shares, I guess, are trying to be traded, like you saw with the GameStop and the AMC whatnot during those meme
Right.
squeezes,
Yeah.
they halted trading, I guess, because from what I was reading, there was so much volume being traded around. I guess they didn't have the capacity to support it, so they had to halt it completely. They couldn't support it. I guess the traffic or the order flow was just too big to
Mhm.
where it couldn't handle it, could not support it.
Right.
But I think that's for certain brokerages. They
Right.
they'll halt, like Robinhood would have halted certain stocks, but other brokerages, maybe like Schwab, Fidelity, Chase, JP Morgan, whatever, they would not have halted. I think it's with certain brokerages that they do that.
Right.
Robinhood is the most popular. They did that in the past, but I was reading since that's happened, like 5, 6, 7 years ago, they've really put a lot of research and money into increasing, I guess they're like, I'm gonna call it like their traffic highway, whatever, and their order flows to where they can support, like larger order flows to prevent stocks from getting halted and whatnot, to where like you could have mass amounts of order flows and whatnot and volume being traded without the stock crashing, because that was a big issue back then.
Right. But what you're saying with the market is it so it's definitely not a similar process. Who sort of sets that line of like, hey, we got to trading's gonna stop here because we're preventing a crazy flash crash, as you
Um,
call it. I mean, and
I
I was just curious. Like, I hadn't heard about that.
I'm trying to think off the top of my head. I believe like I know that has to do with like the larger indices.
Okay.
Like individual stocks will take their crash, they'll sell off. But like as an indice, which holds like a majority of the money, like an S&P 500 index, I know there's usually like a point where like they'll halt trading. And I think like where a lot of the order flows go through, like Wall Street, and then what's the other one? I think Chicago. I think they have like the Chicago Stock Exchange, if I'm not mistaken. Like the New York Stock Exchange, where a lot of these orders, majority of these orders go through those institutions or those entities. From what I know, I guess they'll just halt it. I guess if there's too many orders trying to sell off, like they'll halt it.
How do
And
you feel?
prevent,
Oh, go ahead. Finish off.
I guess it'll prevent like the stock from like completely bottoming out.
Yeah. No, that's totally makes sense now. How do you feel about that as an investor? Who, let's say I'm not, let's say you don't catch it right when it's, the flash crash and you're trying to sell, right? You have paper hands. Yeah, you don't got
Yeah.
the diamond hands that day at least. I know you have the diamond hands every other day, Joe, but like, how do you feel about that as an investor? I don't know. Do you think it's like, I don't want to call it unconstitutional for these companies to have that much power to do that, but do you think it's ethical, I guess?
Yeah, no, that's I think that's a really good word to use here. And you know what? I usually like in my position, I know the market's going to come back. I could
Right,
really care less. Like, oh, it's sold off 20, 30%. That's fine. But, I would be worried about people in their 40s, 50s, or elderly ages who cannot recover from a sell-off like that, who maybe are saying, oh, I want to liquidate my money now before it bottoms out,
right,
right? And I want to try to like save what I can. Because
right,
for a lot of people, like they're not in our position, in our 20s, where we could be like, hey, I can weather this out for another 5 to 10 years. If it takes that long for the market to rebound, for those people, like that's their livelihood. That might be like their lifelong investment, and they need that money now. But if they're not able to withdraw it, like right there and then,
yeah,
and like it's just saying halted, shares are halted right now, like cannot withdraw. Like if I was 70, 80 years old and that was like my lifeline for investments and my livelihood for like, my standard of living, I'd probably be freaked out because I would want to liquidate that money right now to just have it, even if it took a 20% sell off, like let's just say hypothetically. And for them to halt it, I think that would be better than if they just let it ride if they didn't have that fail safe in place. Because if it got halted right at a 20%, like let's just say sell off,
Right.
and that was the fail safe, right? I'd be like, oh, okay, that's great. Like, thanks for that. They halted trading fail safe. But if they didn't have that in place, it could sell to 30, 40%. And you'd be like, oh my goodness, like how long is that going to take off? So that's why, the terminology goes, or the saying goes, like sleep on it or cool heads prevail, because people want to have, such a like a knee-jerk reaction. Like I've seen my portfolio, this is my stock portfolio. I've seen it sell off 70% in the span
Wow.
of 1 year. Now, that wasn't options trading, like contracts and whatnot, call options. That was just stocks. That's when the Nasdaq in 2023 took a really bad hit, 30% sell.
It's
If
like
you were
the
invested,
tech stocks, right?
yeah,
Yeah.
like individual stocks took a nasty sell off. I saw a lot of stocks sell off like 60 to 70%, like good, like quality stocks. But when it finally bottomed out, I thought to myself, and I was honestly, I don't want to say narrow-minded, but I want to say maybe ignorant in how fast the market could return to its normal highs. And I'll give you a perfect example, Nvidia being my favorite. I'm not going to use it post split because they split 10 to 1, but we'll start where it basically maxed out at like 340 a share, I think back in 2021 when the Nasdaq sold off, or sorry, 2023
Yeah,
or 2021.
22 or 23.
I think
No,
it's
22.
2021.
It's a couple years
It,
ago. Yeah.
yeah, sorry, 2021. Yeah,
Oh, was
2021.
it 21? I thought it really didn't take off until 22, 23.
Um,
Oh, you said pre-split. It's probably not that important, but
I am going to fact check myself. Give me 1 second.
you're gonna have people in the comments saying,
I
"Hey,
know, I
what
know.
Joe's
Joe,
talking
what are you
about was that
talking about? Okay.
early."
2023 is where it bottomed out.
Yeah.
I was right. 2023. Never doubt yourself. Went from 340 a share down to about $110 a share. If you held a stock through like a 60 to 70% sell off like that, most people go, oh my, I'm going to cut my losses and just start somewhere else. But I had like a premonition that Nvidia was quite literally like the best thing. I said they're on to something big. It's not them. They've gone through this before in the dot-com era in 2008 and 2020. It's a cycle, like you mentioned before. So I said it's got to bottom out somehow. So I just kept doubling down when it just kept going down. And eventually my average cost was like somewhere between like 100 and $300 a share. And then it pulled back tremendously. It's like, oh, Nvidia's getting into AI. Oh, they're producing this. They're beating earnings and earnings per share. They're doing great. And then it broke 1,000 within 1 year or a
Man,
year and a half. And I was like mind blown. And that became literally, it went from my biggest holding to literally my smallest holding because it lost so much equity. And I didn't really put as much money as into it because I already had a lot into it. But when it came back, it became my biggest holding by far, not by accident. It's just because it just grew that much.
yeah.
And I'm still buying the stock. I think it's at a great price level. But I think that's a great thing to know is that when you have like individual stocks, I'll be very brief here. Like individual stocks, very hard to know like which one is going to do well over time. So I put a majority of my money into individual stocks that I know already have a strong foundation and a lot of strong history, and primarily those that have survived the dot-com crash in 2008.
Mm.
You can find those stocks, which, they're pretty much the largest stocks in the S&P. You're probably going to do fine. The new stocks that have been around for a couple of years, very risky because, we don't know a lot about them. We don't know what type of product or service that they're offering is going to be able to actually benefit people in the future. Are they going to, be devaluated over time? I don't know. But, to go back to your point of, you know, looking at like a heavy sell-off, like I've been there, it sucks a lot. But then people go, oh, you can invest in an ETF, right? Like a conglomerated fund of companies. And, you would have lost like maybe 20% plus of your equity, but the returns would not have been as high as those individual stocks. So that's why I'm willing to take that extra risk with individual stocks.
And also because you're much younger, or I mean, you're younger, right?
Yeah.
This, the people talk about that all the time. Older people do, like, hey, take the risks when you're young and fail often, fail forward, because when you're, again, like we mentioned, maybe not even 70, 80, but because that's a little late, I think, but maybe even in your 50s, right? Or early 60s, 2, 3, 4 years before retirement, you're probably not going to want to put, 30% of your holdings on one single stock. And
Yeah.
yeah,
Because,
you regret it. So
right. That's your livelihood. I mean, people want to live comfortably, but, I don't think people truly understand that. it depends on your financial situation. It depends on expenses. It depends on like a million different factors. When it comes down to it, I feel like, if you want a lot of return, you have to be willing to risk, right? And if you invest in the market, you have to be willing to invest into a company and make kind of like an educated guess that it's going to be able to do well. And I've had, like maybe one or two like penny stocks that actually have like become valuated at, they've actually provided, but those are like one amongst many that have not done well. And I'm like, wow, okay, like 1 out of 10 finally succeeded. And luckily it was one that I put like a decent amount of money into because I started following what this company was doing, trying to digest exactly like, what their technology is providing in their industry and sector. And then they started winning like, tech awards. They started acquiring other type of entities. They started paying off their debt. They started beating expectations. I said, they're doing everything right a company should be doing, right? People should like companies should follow by that example. Not like, oh, the AI hype, right? I'm gonna invest in 5 companies and just because it's an AI company, it's probably going to do well. But if they don't offer anything beneficial, if they're just a company that's been stagnant for years, what makes you think they're going to be able to pull out from that?
Right? What's their edge? What's the differentiator? That's what I think one of the things you have to look at. So you think, obviously, we probably agree that investing in penny stocks is a bit of a guessing game, but you shared a little bit about what you look for when you're sort of investing in other companies. But do you have sort of like a bullet point list of like the 5 things that you want to look for when you're making an investment in a single company? Things to look for maybe like and I'm kind of changing the I mean, I'm staying in topic, but I feel like I'm hitting you with a lot of questions now.
No,
But
no, it's
yeah,
fine.
I
It's
kind of want
fine.
to know this, and I
We can
think
go both ways. It's
yeah,
fine.
people can.
Um, yeah, I'll keep it brief. I like to look at leadership, right? Leadership is a very important thing. When you look at like giant companies that are very well known, a
Yeah,
lot of times if they're a very popular company, it's because they know the CEO first. Like, oh, Meta, oh yeah, Zuckerberg, right? You look at Amazon, oh, Bezos, Tesla, oh, Elon Musk. When I look at like maybe a penny stock, for example, I look at the CEO and I like to do some research on like where did they go to school? What do they do for fun type of thing? People go, what does it have to do with the company? I said, you'd be surprised how people treat their companies by the way that they live their lifestyles, right? Like Jensen Huang, I have nothing but respect for him. He's given a lot of shareholders a lot of value, but in terms of like the company itself, he never stops working. He works like 7 days a week from the moment he wakes up
right,
and it's insane. But he enjoys what he does, and
right,
he doesn't take no for an answer, and he keeps trying to uplift people around him. He doesn't let them quit. Says he does not allow them to quit. If you have the CEO telling you, "I'm not going to allow you to quit on yourself because firing you is too hard," it's too easy. That should send a real message. That is a leader. That's someone who's bringing the ingenuity, the leadership, whatnot. But going back to penny stocks, it's really hard to know. I'm gonna be honest, I don't really have a bullet point because I don't invest in that many penny stocks, but I think it comes down to a lot of conviction because you could look at everything that you were taught in finance and economics and be like, oh, you look at this, the company that I made a decent amount of money in
yeah.
is in the AI sector, the like voice recognition.
I'd
Their
love to
value,
know which company. We could talk about it after the podcast, but
oh, of course, this company, they're still not profitable. Their earnings per share is still negative. Yet in the last year, their stock was up like about 1,000%. I said, how does that happen? Because I had a lot of conviction, not just because of me, of course, but because I researched a company and I looked at what they were obtaining patents for is very important in the tech industry, getting patents for specific things. It gives them power to like, acquire things or to keep hold of, power, what do you call it? Like certain types of information that they could use that's beneficial for their products or services that other companies can't, like, basically they don't have the power to use in a sense. Like, a patent, you know what a patent is.
yeah,
And this company wasn't profitable yet, but I was researching. I said, they're doing everything right a company should be doing on an upwards track. They
right.
need a catalyst,
Mm,
and that catalyst is going to drive them out. But for right now, they're stagnant. I held onto that stock for over a year and a half before it broke out from what they call like that resistance.
right,
And like most people say, it's done nothing for 6 months, on to the next thing. But I had conviction. I said they're acquiring, different types of entities or, like research models. Um, they're getting a lot of partnerships, which is huge. They're branching out in different types of industries, like whether it's like automotive, the food industry, um, the healthcare industry. I'm like, they're doing everything right. Why haven't they been noticed yet? Because it's under the radar.
Mm.
And then it took a conglomerate, not conglomerate, an aggregate, in the AI industry to basically say like, oh, hey, we're basically like invested in this company to where that penny stock just took off because it's the name. The name said, if you're working with that small company, we should probably invest in that. That's the only reason why. There's
Okay.
got to be some type of value why that large aggregate wants to invest in that small company. They see something that the public doesn't see because those two companies are collaborating. They're talking. They're possibly doing business with each other. They're possibly sharing technology. I don't know. And I was lucky because it was just kind of like the right pick at the right time. And, I do think that, it's something that could yield a lot of money in the future. But, going back to like a penny stock could be, like you remember Tesla, it had negative earnings and people were still buying it. It was still up 2000%, like 1 to 2 years, but
Yeah.
it wasn't profitable yet. So I don't know. I don't know where I'm going with this, but like bottom line is I feel like I failed myself in certain ways because I applied what I learned in finance and economics to not buy certain stocks that actually went up 1,000%. And then when I did not apply the rules of finance and economics, I made a lot of money in certain stocks, which they should have not made money in. They should have not gone up according to the rules of finance and